Okay, so we are unmuted and we are live on YouTube, so we should be good to go there. I will slide down here for the time being, and then when it comes time to adjust for the presentation, I'll do that as well.
Okay.
We'll go ahead and call this meeting of the Investment Advisory Committee to order. It is 2:01. And present are Commissioners Sabrina Christian Bennett and Tony Badalamenti. I am Treasurer Greg Cromus, and we have Eileen Stanek from Meter Investment with us as well. So just to begin, this is our annual reorganization meeting. Hard to believe we're still doing those in March, at the end of March, but here we are. So we will first do our nominations for officers, and then we'll talk about meeting schedule and policy before we get to our normal agenda. So
I will nominate Brad
to serve
as
as,
the chair.
okay. I think I can do that. I'm just keeping the record. Is that okay with you? Okay.
Because
good.
I was gonna nominate you as well,
Okay,
and
good.
I was like, that's why I asked you if you wanted to be chair.
Yeah, we can do that. I'll accept the nomination. Thank you.
Okay,
Would you second that then?
yeah,
Okay.
I second.
Great. All in favor signify by saying aye.
I,
All opposed, same sign, and abstentions. No motion carries there. Nomination for vice chair.
Sabrina,
are
Okay,
you gonna
good.
be the secretary?
Yeah.
I'm beginning to feel like one.
Okay.
I'll second that. All in favor signify by saying aye.
Okay.
All opposed, same sign. And then Tony, I'll nominate you to be the secretary.
I will second that.
Okay, good. All in favor signify by saying aye.
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 Get out of your comfort
Okay.
zone a little.
So, next order of business then is the meeting schedule for 2023/2024. I sent that to you before the meeting. Sabrina, you
Yeah.
have a printout of that. I didn't bring one over with me. So can you read out what those dates are?
Yes. Meetings will be held June 22nd, 2023, September 28th, 2023, December 28th, 2023, and March 28th, 2024.
Yes, good. So those would be our 4 meeting dates for the coming year. The 24th would be reorganization for that next year. So that's my proposal. Do you have any objection to those?
I concur.
Okay, good. So, all right.
I was just
good.
gonna say, just work for Eileen, that's
The most important.
One.
Right, good.
Me too.
So motion to approve that then.
So moved.
Second.
Moved and seconded. All in favor, please signify by saying aye.
Aye.
No abstentions or no votes. That passes. So next order of business is policy review. This is something that we have to do every year during our annual reorganization meeting. There are some changes. So the things that are flagged there on the agenda, membership, you have the option to do the 2 commissioner model or the 3 commissioners plus clerk of courts model. We've never done that. I don't think there's any need to, but it's in our policy that we ask. Same with meetings and record keeping. We just set our meeting schedule, so I think that we're covered there. Record keeping is on there to review. I am the custodian of records for us and have been for a while. So I'm comfortable staying that way. No need to change that. So unless you all have objections to those first 3 things.
No, sir.
Okay, policy revisions then is the next part, and there are a couple of those that I gave you in a draft here. For the most part, this is gonna sound stupid, but it's taking the double spaced and making double spaced beginning of sentences and making them single spaced, because that is now the preferred thing. I don't know why.
Well, I was
It's
just
like
getting ready to
deeply,
resign
I-
because I couldn't stand it.
deeply
I'm
grammatical.
confused.
I know. Yeah, this is like the attorney in me, so a lot of that's that. The only things that are like
Are
substantive.
these single space, Brad?
Sorry.
It looked like there's no space.
Yeah, well, you know,
Just checking.
they should be. Yeah, it's these ones at the end of the sentence. Anyway. So under ethics, I just kind of changed the language there a little bit about maintaining integrity and public trust in the process. I didn't like the way it sounded before, frankly. So it's the same meaning, but differently worded. Under investment objectives, I corrected the second paragraph under safety of capital. I had the wrong insuring in there for God knows how long, so we have fixed that. And then the last paragraph there, I added the words where possible about maintaining liquidity. That's the reality is we maintain liquidity all the time, but it's one of those things to give us a little bit more closer relation to what we actually do. At the bottom of that page, we've got yield over the long term. And then the biggest addition is on the top of page 3 and into page 4. The top of page 3 is where I try to incorporate some language that specifically accounts for the existence of our linked deposit programs. where we're intentionally taking a haircut on return for the, provision of a public policy service. So we do that. The old policy let us do that, but this is just, I think, clearer language around that. And then on page 4, those are the top of that page. There's some restructuring on the language, but it's the same thing meaning wise. And at the bottom of that page, then there's a piece about trying to broadcast electronically, making a reasonable effort to do that. Because we've been doing that for 2 or 3 years. And again, we never had that in there. So I wanted to include some language on that. So those are the changes proposed. I don't know if you all have any that you want to add, subtract, multiply, or divide, but that's my.
No, but you know what, Brad, if this ever becomes a problem, we could always use our boardroom because we're getting all new state of the art
Well, that would be better.
electronics.
Yeah.
Seriously.
Have you been up there lately?
Yeah, it's
No.
You
all
need to come see the new digs.
Yeah.
Yeah, very nice.
Yeah. But
Cool.
I just wanted to offer that to you with us trying to adjust.
Well, it's certainly a lot easier than this,
And
right?
then-
And more reliable.
Yeah, that would be great.
So,
Yeah.
Upstairs.
Yeah,
too.
we'll wire, put it on the big screen.
okay.
Yeah.
So for the time being, we'll keep. Actually,
We
the
could
notice,
change
I
it
could
for
change the
next-
meetings to being up there if you want to do that. That's
Yeah.
fine with me.
And the 7th floor and the
That'll
board
be
of
more-
commissioners. boardroom.
Yeah,
Yeah.
it'd be more conducive, and easier for you.
Okay.
Yeah, and if you come up a little earlier, we can set up your.
And then the PowerPoint can be on
PowerPoint.
screen. and
Yep.
everything. So yeah,
Yeah.
absolutely.
Oh, good. Does that work for you?
Yes,
Okay.
Cool.
It's a little bit longer distance.
I have to read the other one.
Yeah, I say like a year.
Oh, it's good for your
The
steps.
great things we do for you.
Okay. So I think then I need a motion on the policy
Make that
revisions.
motion to
Okay.
accept.
I'll
Yeah.
second.
All right, moved and seconded. Any discussion? No. All in favor, please signify by saying aye.
I,
No opposition or abstention. So thank you for that. I will update those. I'll get you a clean copy
Yes,
because
yeah.
you have to sign off on it.
Yes, right.
And then we'll send that signed off copy to the auditor's state.
Right, and that's,
for
you
their-
file that through your e-services account.
Yeah.
With the auditor of state.
Yep, yep. I'm glad that you knew that because I was gonna have to look it up. So thank you. There is no longer a clerk of the bureau, which is the way that I used to send.
I
notes.
know, I know.
I still not
She
sure.
must have
it's- I
retired,
just
I
love the
think.
title. I want that title. Okay, next thing then is regular business then. So that concludes the annual meeting portion of today. We've got minutes from December 29th. You will have those in advance.
Mhm.
So
Accept it as is.
they moved by Tony,
I'll second.
moved and seconded. All in favor, please signify by saying aye.
I,
Aye. No opposition or abstentions. That passes. And Eileen, without further ado, it's the floor is yours. I'm gonna try to
Thank you.
share the thing too down here.
Oh, okay. All right, so I'll give you a second there, to get that up and running. But, as I said to Brad, this will be an interesting meeting because our timing is interesting from the standpoint of the events that have occurred here over the past couple of weeks in the banking industry
Mhm.
as
Yeah,
well.
yeah.
And so, yeah, it's.
It sounds like there's more to follow suit with some of it. Even though I read an article last night saying that the banks are sound and we shouldn't, but then, yeah.
right, where'd you go, friend?
As we recognize, banking is a business of trust. So you take your money, you have to have someplace to put it. So we
Yeah.
have, banks set up to accept individuals and businesses and public government entities' monies, and we trust that that money will be there when we need it. That the bank is, of course, subject to regulation that makes
Yeah.
sure that they have in place safe and sound practices to ensure that those funds are available when you need them. So what we have learned, I think, to this point, over particularly what has occurred with the Silicon Valley Bank, is that unfortunately, perhaps in that situation, the regulatory oversight wasn't as effective as it should be.
It was lacking.
It
Yes.
failed. And that's what you hear is everybody that you hear talking heads of the accountants and the advisories are saying that how poorly it was run.
Yeah.
Mhm.
And apparently it's been going on for several years and the regulatory system did not work.
Well, and they were overseen by the California Financial
Yes.
Protection Office, which is
Right.
really interesting that it was a state-based,
Mm.
state-based regulator and not the federal system.
Right, for a bank that's the 16th largest.
yeah.
bank.
Is
Fascinating.
that normal to have a state regulatory?
Not for a bank of that size. I would say generally those types of regulatory environments are more appropriate for the community banks.
Mhm.
But as we know, in, looking back through Silicon Valley Bank, over the past 2 years, their deposit growth grew by 300%. So at one point, they were a much smaller bank, but they just kept growing because they were so connected to venture capitalists and the startup world, where
There we go.
what they do is they generate a lot of cash. They put all that cash in, and then they use that to fund their startup businesses. So venture capitalists were very successful in, generating all of this cash. Unfortunately, though, much of that cash was then parked at Silicon Valley Bank, and Silicon Valley Bank, of course, did what any bank does, which is, we're receiving cash. We do one of two things. We either loan it out or we invest it in treasury agency securities to be able to make a return to cover our costs and to also give, nominal interest payment to, to the depositors, right, and have a profit to give to the shareholders. Well, when we think about the fact that, their growth period was 2020 to 2022, well, where were interest rates then? As we all know, very low, record lows for an extended period of time. So as they received all these funds in, and we're reinvesting and investing those funds in safe investments, U.S. treasuries, agencies, mortgage-backed securities, very safe investments. They were investing at a time when interest rates were very low. So what had happened in 2022, as we know? Well, 2021, inflation became a problem. 2022, Federal Reserve embarked on raising interest rates at the fastest pace since the past 40 years, raised rates by a full 4%. And as we know, what happens with fixed income securities is there's an inverse relationship between the value and market and interest rates. So as interest rates go up, the value of your existing securities go down, because let's think about it. If you buy a security that has a 1% coupon and you pay face value for it, and interest rates all of a sudden are at 4%, and if you needed to sell that, well, no one's going to pay you face value for that, because why would they? They can buy a new security at face value and earn 4%. So in order for a buyer to buy your security, you have to take a lower price than face value in order so that buyer is earning that market return, that 4%. So basically, Silicon Valley had this portfolio of longer term treasury agency and mortgage-backed securities that had been purchased in very low interest rate environment. They were now, of course, in a situation where those securities were worth much less than they paid. And that is a condition that anyone who is in the fixed income markets experiences. The county, the value of the securities is less than what we paid for them. The state, the value of their securities, everyone, because that's just a function of the fixed income markets. That's just how it works. And that's okay. You hold to maturity, you get your par value back, and you make your reinvestment decisions, and keep sufficient liquidity on hand to cover cash that may go out the door. Right. Well, what happens in a banking scenario like it did in Silicon Valley is they may have had what they felt was sufficient readily available assets, but a run on the bank started. Because all of these startups, this venture capital world is all rather interconnected. So once one kind of sounded the bell, did you look at the financial statement of Silicon Valley Bank? All of a sudden, their value of their assets are less than what they have in deposit. Maybe we should move that money.
And that's what happened.
And it just snowballed. So,
and they said that they had invested a lot. It's a wonder they held off as long as they did, because they had invested a lot in the Bitcoins, I guess, and lost a lot of money there on top of everything with the rates and stuff. They were surprised that I was reading last night that they actually hung on as long as they did.
Yeah, that's interesting. And that kind of raises the point too, right? Where were the regulators to step in sooner than waiting for there to be a run on the bank which then, of course, created a panic situation within the market because it was all of a sudden, well, oh my gosh, look what's happening over here. Now let me look under the hood at my other banks
Mhm.
here, or let me not even look under the hood, let me just get out of there and move monies into US Treasuries, which are the safest investments. And so clearly, this all transpired, starting basically coming to light, I would say on March 8th, which was a Wednesday. March 10th was a Friday, that's when Silicon Valley Bank was closed down. March 12th, which was a Sunday, the FDIC, the US Treasury, Federal Reserve came out with their plans, which was to number one, to extend full FDIC coverage to all of the depositors at Silicon Valley Bank and also at Signature Bank. And, the big question that has been, kind of in the talking heads, well, why would they do that? Well, they did that because they wanted to reinstill that trust in the banking system, because that's what the banking system is about. It's a business of trust. And they wanted to stop the contagion spreading to other banks. And so by offering that full FDIC insurance coverage, then said, well, okay, yeah, your bank was a bad actor, but you as a depositor aren't going to have to be the one who bears the cost of your bank being a bad actor. We're going to make you whole so that, yes, you as a business can still make payroll to your employees. As an individual, you can still pay your mortgage or your rent or pay for your food, to feed your family, things of that nature. You're not going to be, hung out there to dry just because the bank was a bad actor. And then, of course, additionally, in order to also calm the markets more, the Federal Reserve instituted a liquidity program, which allows banks to borrow money from the Federal Reserve, post their collateral at face value, i.e. their investments, and borrow money if they're experiencing unusually large withdrawals. So let's say all of a sudden, right, everybody's watching the news and going, oh my gosh, I'm scared, my bank might fail. I'm going to run down to hometown bank,
All over the
whatever.
country.
Yes, all over the country,
Yeah.
and pull money out of my local bank. And the local bank is going, oh my gosh, what's happening here? Well, then they can go to the Federal Reserve and get liquidity, get a loan, get monies in order to fund those withdrawals. And in essence, pledge those investment holdings to the Federal Reserve as collateral for the loan.
So you had many people talking about, well, let them fail. It's okay for a bank to fail. And that would have a domino.
They fall like
effect.
dominoes. Yeah,
Exactly.
they're all interconnected, right? I mean, that's the issue.
Yeah, exactly. And we know it's not just in the US. It's a global.
Global bank now.
Yeah, we're a global financial system. And so what happens if something like that would have happened in the US, it would have spread to the other countries. That's why.
And the other silver lining is it's not taxpayer money. FDIC money is money that the banks pay into that system for the sake of having the insurance. So
Yeah.
that is useful,
Yes, that's like any investment.
and part of the reform post crisis when we're getting close to that, I think. But
Yeah,
whenever we're
we hope
out,
so.
right? The look is to maybe raise those rates, right? Those insurance rates. I know that's one of the things they're talking about, to add the buffer, because just a couple of banks failed.
Right.
And they could make everybody whole over and above, because
Right.
FDIC insurance only covers the first 250,
Mhm.
250,000.
And after that.
And they made everybody whole up to no matter what, right?
Yes.
So
Yeah,
that is
That's a
unusual.
lot of people. That's a
Yeah.
complaint.
Yeah,
I had $1 billion, you had 250,000, they're gonna cover me just like they covered you.
yeah, which,
Mhm.
Yeah, well, I heard that they already started the new bank, the Silicon Valley, I forget
The
it
Bridge
has
Bank.
another name,
Mhm.
but everyone, they made them whole with money, but I thought they had to leave the money there. They were not allowed to just all of a sudden go in there and start. pulling
Probably,
it out.
there's
There's
probably some
limitations.
limitations, yeah, that would
Yeah.
make sense.
Yeah.
Yeah, to stabilize things. Yeah, and I think the other point we're seeing too is, now that, again, it's like, okay, why didn't the regulators catch this? Or if they did flag this, why weren't they able to do anything or what have you? We would clearly not be surprised to see increased regulation on the banking industry as a whole. Not so much the money center banks, because they are already subject to a higher level of scrutiny. Through the Federal Reserve, they undergo stress testing that says, okay, well, what would happen if the right interest rates went up to 10%? What would that do to your liquidity position? What would that do to your investments and the like? And do you have your balance sheet established so that you could weather that storm? The smaller banks are not subject to that. They're subject to a lot, well, comparatively speaking, a lesser level of scrutiny and regulatory review. And so one of the points that's being tossed around up there is to increase that level of review of the remaining banks, so that it protects more people. And from the standpoint of that, if banks get themselves into a liquidity position or a bad financial position, that it is identified early enough and an action plan could be put into place to either, number one, find a buyer for that bank, or find a plan that they would have to follow in order to restore their financial condition.
So
All of that
changes are
about-
coming.
Yeah,
Yeah.
all that about 10 days before the Fed met too.
I know, yeah.
So,
Well, it's interesting because, right, the Fed did meet and the market was like, oh my gosh, well, will the Fed do no change in interest rates? But, we stepped back and we said, well, the Fed has their eye on inflation. And that doesn't, this banking turmoil doesn't change that. And so the Fed, we think, clearly played it well from the standpoint of, if they would have chosen to say, well, we're going to pause because of the banking turmoil, that could have fed into additional concern in the market, because well, what does the Fed know? We don't know. Versus the alternative would be if they would have gone with, say, 50 basis points, then it would have been, oh my gosh, this is going to make it worse, and we're going to see more trouble at more banks. So I think the 25 basis points was right in the middle. And the market, as we got closer to the Fed meeting, was pretty much aligned with that as well. So there was no surprise.
So the overnight borrowing rates going from 4.25 or 4 3/4 to 5.
Yes, to 5. Yeah. I will say this, when I watched, I had it on in the background, the press conference where Chair Powell does a press conference after each meeting. I said, wow, he looks a little disheveled.
Rough couple of weeks.
I've been sleeping. Yeah.
He looked a little off his game, I will say that. But he did I felt a good job of sticking to the message, and also sticking to the message that the Fed is not done raising rates. Because again,
Inflation's still
inflation
up.
is still a problem. Inflation is at 6%. We look at the consumer price index, the Fed's target is 2%. And there's still a pretty good sized gap between those numbers. Better than where it was last summer when inflation was at 9%. But they still have some work to do.
Where do you see interest rates going? Topping out?
We see interest rates topping out more in that 5.25% range, which is pretty much in line with what the dot plot is. And then of course a lot will be dependent on the economic conditions. Have started to see, of course, more companies within the tech industry and even within the bank industry prior to this banking turmoil increasing their layoffs. We know the labor market has been too strong coming into this, so clearly seeing some reduction in some of those numbers will be positive, relatively positive.
When you say labor market's strong, and then you hear just about everybody saying, I can't find people.
Yes.
So how do those two interact or justify
Right.
the statement?
Strong meaning
There's lots of jobs.
is that there's lots of jobs,
Mhm.
and to your point,
Nobody
can't
take them.
The
You
market
can't get
for
people.
labor is strong.
yeah, the market for
Okay, all right.
I'm laughing because when I said Bitcoin, it looks, it's right here in review, Bitcoin dropped 64%.
Yeah, you've
And
got
that's what I heard. They were heavily
FTX on there
invested in
too, yeah.
in Bitcoin.
Yeah,
There's a lot of young people that got relatively wealthy that had $1 million in the bank that no longer have.
right.
I know several of them.
all a gamble.
Right.
Yeah.
Go to the casino, that's what happens, so.
That's right. But clearly, right, we've had now 2 rate hikes in 2023. Expectations are that we will have at least 1 more rate hike, if not more. When we look at the dot plot, which is the forecast that the Fed issues that just came out yesterday as well. Did not make it into this because this was already printed and sent. Shows that there's a wide dispersion as far as what the Fed members believe the interest rate environment will look next year. But the overall message that the market is taking, that the Fed is communicating, is that rates will be lower in 2024. Now, granted, we've got a lot of work to do though on the inflation front in order for the Fed to reverse course. And it was interesting in the press conference yesterday. I want to say that was probably one of the last comments that Fed Chair Powell made, which was to the extent of, well, basically, we're not going to be cutting rates in 2023. And, arguably so. As long as inflation is still a problem, and this is the main tool that the Fed has, is interest rates, then yeah, they do have to stick to the plan. Now, granted, this banking turmoil and the outlook for increased regulation on the banks may tighten those financial conditions. So meaning banks may be more conservative in lending money out, which could also serve to help to slow the economy.
Right.
So it could do part of the Fed's job, but it's not going to be the big driver. I think it's still an interest rate story. So, of course, our job is to be very attuned to all of this and to follow all the economic pieces and look through the tea leaves and structure, the investment strategy, investment portfolios, appropriately based on what we know and we see going forward. But it's
I remember being very young when the 17, 18,
Oh, yeah.
19%, and just like, I'm glad I didn't own anything back then. I was in the Marine Corps, it didn't matter what was happening.
Right.
That had these scary times.
it's funny you say it because when my husband and I, when we purchased our first phone, our mortgage was at 14 3/4.
And you felt good about that, right?
Right.
Yeah, because it just.
Because we were-
lifesaving.
And we were able to
Yeah.
get a mortgage too. That was another
Yeah.
thing too.
I know
Yes.
my husband, I remember seeing old mortgage papers. He got a VA loan in 80, I think it was 83 or something. It was
Yeah.
12.99.
That's great. Actually, when it started coming down,
Yeah,
by mid-70s, it was 19, 20%.
Yeah,
yeah,
Yeah.
exactly.
I was like, what?
Yeah.
But that was the norm back then.
Yeah, and those high interest rates definitely put a kibosh on the
Everything.
economy,
Yep,
to
so
say the least. I mean,
absolutely, you didn't want
And
to.
set the stage for the boom that came after, right? I mean,
Right.
the early 80s went nuts economically for the same reason.
Right.
There's all that pent up demand.
Mhm,
So,
right, exactly.
Yeah.
Yeah, and my husband always tells the story, and I don't remember this, well, yeah, during that time, we were buying our bread from the, they use bread store, not these bread store. but-
yeah.
The day old.
Yeah.
The outlet.
Yeah, absolutely.
You sure I never said, what in one of those, you must have been doing.
He was doing the grocery shopping, huh?
If you say so, Jerry. But I'm sure, right, we were definitely, it was very tight belt
Mhm.
time period, to say the least. But yeah, so any event, when we think about the inflation picture, one of the pieces that is embedded in inflation today is the cost of shelter. We know, of course, housing prices were on a tear for years, but they never really flowed through to the inflation numbers because clearly, when you saw housing prices going up 10, 15%, you go, well, wait a minute, inflation isn't even at 2%. What's happening here? Well, what was happening is the way that the cost of shelter is filtered into the consumer price index. And it's based off of a rent measure. And so when we look at the blue line, we can see that this is the portion of the consumer price index that's attributable to rents. And that has gone up here just over the past 2 years. So again, there was a lag in those housing prices translating into higher rents, which translates into higher inflation. But when we look at the real-time rent indexes like the Zillow Rent Index, it has trended down very dramatically here of late. And so the expectations are that the portion of the consumer price index that's attributable to housing will start to trend down as well. And that will also though help that inflation number to organically start to drop. But it's going to still take some time because this all happens
Mhm.
with a lag, about a 12-month lag.
Mm.
But when we think about inflation, and from the Fed's perspective, one of the things they're really concerned about is if inflation remains high and it gets embedded in the cost, in labor costs. And particularly when we think in terms of the service industry, which is predominantly, their largest cost is service, is
labor.
labor,
Yeah.
exactly. That then if it becomes embedded in that,
That's hard to get back out.
exactly,
You gotta stay there.
right, you have to stay there.
That's
So
almost double.
Yeah.
McDonald's is almost double.
Right.
That's.
it's crazy. But I guess, the good point is these measures are starting to trend back down. And clearly we, have not seen anecdotally, all the signs up for bonuses to hire people.
Mhm.
So those have kind of dropped off.
Mhm.
Yeah,
Mhm.
and it's dropping off in the medical, because there's just no way they can continue to do that. I
Yes.
mean, they're not swallowing that, they're passing it on and it's
Yes.
a trickle down effect.
Yes, exactly. Exactly. So yeah, this is all, played out in the yield curve. When you look at the US Treasury rates, bottom line where we were at the end of last year, turquoise line in the top where we were at the end of February, which were really not too far off from those levels. But I think the key point here is looking at the shape of the yield curve. The turquoise line, we have a very highly inverted yield curve. So what that means is the short-term interest rates are much higher than the longer-term interest rates. This morning, when I looked at it, that inversion, when we looked at the yield on a 3-month treasury bill versus a 10-year treasury bill, was a full 1.25%. That is unusually large to have that much of an inversion. And that inversion, this in interest rates, is a pretty reliable indicator that a recession or a very strong slowdown is on the horizon. So whether that takes 6 months, 12 months, 18 months, the market conditions are pointing in that direction. And so from our standpoint, as we look at these events unfolding, and this changes in the interest rate environment, we believe it's prudent to lock in today much of those longer term interest rates today, which are still at levels that we really haven't seen since going back to probably 2009, back in the housing crisis, to provide some certainty in the interest income for the county.
You say that's about 1 to 1.5%.
That inversion. Yeah. I don't think we've had an inversion that strong, I think I read, since 1981.
Wow. That's right after we were just talking about.
Yes, exactly. Yeah, so very, very telling. So the county's investment portfolio at the end of February, of course, cash is a little high, because you're in collections, we know that. Securities just under $168 million invested. The weighted average yield is at 2.51. So as we've been reinvesting maturities, those have been at much higher rates, ranging from around a 3.50 to a 4.25 as market conditions change. So that has been accretive to the rate. If we just do some simple math of the securities portions times the 2.51, that would mean the investment portfolio on a 12-month forward basis would be earning at least 4.2 million. So definitely a number we haven't seen in quite some time.
I find this fascinating.
Yeah.
Yeah.
Maturity distribution here, kind of our bifurcation point that we look at is beyond 3 years. So if we look at these last 3 buckets, we have 31% of the portfolio maturing beyond 3 years. We would like to increase that to upwards of closer to 40%. Now, of course, we're always going to want to keep within that 0 to 1 year bucket at least 20%. And so, of course, that would equate to well over $30 million always maturing within a year, which would, of course, provide that liquidity if Brad needed to take money out of the investment portfolio to move it back into cash or the like. Oh yeah, and here's the purchases just over the last quarter. We did not have many maturities, so the activity was rather limited. Weighted average yield on those was at 3.85, so just under 4%.
But that'll be picking up for our next report significantly. So
Say that
Yeah.
again one more time, sir.
that'll pick up for our next report significantly.
Yes, right, exactly.
Yeah.
Year-end statistics, just that comparison, again, we have not since the time we started tracking this. Had the portfolio not only at this size, but also their conjunction with the size, just being able to know that the county will be earning over $4 million just on the investment portfolio. So we want to make that $4 million last, like be repeated year to year to year,
So
if not more.
Yeah, I mean, if you look back, so 2007 is the last time we hit 4
Right.
prior to, so
Portfolios half the
and-
size,
and
but
it's-
still.
yeah, just for frame of reference. So,
Mhm.
you know,
how long have you been doing this for us?
I have been working with the county probably since 2006.
Yeah, long time.
Yeah. Yeah.
So with the numbers.
Since these are out.
So you were at the low end of that.
Exactly.
What's the philosophy that you've done to get this to this point? That this was continuing, because the first time I came down and it was just like, wow, that we're doing pretty well. People look at that. What's the different philosophical thought process that you guys had in 2007 that we are right now? Can you
Okay.
compare that?
Sure. So like in 2007 up through 2013, the investment advisory services were provided by a company called Productive Capital Management, which was a much smaller firm. And I was part of Productive Capital Management through 2010. I then left and went to the dark side, but then I came back for a little bit. But it was a much smaller firm and with much more limited resources, provided a great service to clients. But we contrast that to when Meter purchased Productive Capital Management in 2013, and Meter is a much larger organization, has much deeper resources, more expertise as well in the fixed income markets. I think that has been one of the first very big differences over the term of the county's investment experience. So from 2013 on, of course, we were in an environment of very low interest rates then. So
I was gonna say,
Very
look at
tough,
the difference
yes.
between
Yes.
21 and 22.
yes.
I mean, that's huge.
Mhm. Right.
Like I said, I remember when we were barely getting one.
Yes, exactly.
It was the low.
Yeah, and so exactly, when we think about 2020 and
Yeah.
2022, rates were basically zero, but yet we had the county's investment portfolio structure. We were kind of riding through that tide. And then now, of course, being in a position where, interest rates are, trend is being our friend, as well as the fact that the county has more funds, and being able to structure that portfolio. So clearly, I think it's the depth of our resources that is really the key that drives the investment strategy and how we provide that advice to the county and structure the portfolio.
And part of that too has been intentional on our part. We have been pretty aggressive at looking at the market and saying, over and above the market here, but I'm talking about the market for investment firms. We've gone a couple of times to bid and asked people to provide information and Meter, to their credit, we have a relationship with, but they were far and away the best bidder. And since that time, they have merged with some of the other, larger players in the market. United American Capital was another big one that a lot of counties utilized.
Right.
That brought on, excuse me, mergers are like marriages, right? Who proposed to who? So anyway, excuse me, right? But they brought on a lot of expertise as well. Dennis Jacobozzi was the guy who ran United American, and he's been in this space in public investing for a long, long time too. So, we feel really comfortable about the way that's gone. And I think that we've been, willing to have conversations about different sorts of products than the county was in before, right? So talking about corporate paper, commercial paper, and some of those sorts of things. We've been open to having those conversations, which I think has unlocked some things for us too. So
I would agree.
Yeah.
Yeah, absolutely. That's a good question.
Everyone's fine.
Yeah. Right, and then we just wrap up with the listing the inventory of the county's investment holdings.
and I'm clicking through these rather quickly on the slideshow because these are viewable If you ask for them, this will be posted on our website after we're finished with today's meeting.
Is
Um,
home savings
so-
is part of Premier Bank?
Yeah, they're required by premiums.
Right. Mhm.
And not to get confused with post savings,
Their
but
hometown.
or home
Yeah.
town now, which
Right.
gets pledged, but yeah.
Premier moved it to right up the street from where in Bainbridge, probably about 4 or 5 years ago.
Okay.
And I just transferred my office accounts to Premier.
I would think there'd be more consolidation in the banking industry.
Mm.
I bet.
I'm surprised to see that.
Imagine that'll be the case. Okay, so any questions for Eileen further on the portfolio review?
Oh,
None that I haven't had.
Motion to accept that as presented then,
I make a motion to accept.
oh, second,
moved and seconded, all in favor, please signify by saying
Aye.
No abstention or no votes, so that passes, and then we're into other business, so. Just quickly, GrowLink, I try to give an update every meeting about how that's going, our link deposit program. We've been doing a pretty aggressive job of talking to people about this and making sure that they're aware of it. We really started that in December, January. I've had a chance to do a couple of presentations about it in various settings, and so we're starting to see that pick up a little bit. We have done just under $500,000 in loans, so we've got $1.5 million left. Which, given where we started, I feel pretty good about. We've had 3 recent business loans that we've done. One for a trucking company, one for Fitness Anytime, and I think there's one that's still pending for another entity, as well as a lot of inquiries. So I think that that'll really start
Word's
to pick up.
getting
We've
out.
been talking a lot with the Portage Development Board about it, and they've been featuring it in their newsletters too. So
What was the 2 million is?
2 million is our starting amount in there. So, you know, at this point, we're authorized to do up to that. At some juncture, we may want to look at more. We'll just kind of have to see how it goes. We wouldn't go a whole lot higher than that last year. Maybe 2%.
I heard the heartbeat.
Maybe
Flutter.
is the ceiling for that. We talked about that,
Yeah.
1.2% of the
Yeah.
portfolio.
So yeah, that the new policy.
So,
Yes.
right,
yeah, and the
Um,
road links are through, they can apply for those through.
hometown and Portage Community. Those are the two.
Middlefield dropped off.
Middlefield's going through some structural stuff and
Yeah,
in
they got some new
conversations with them.
leadership.
Yeah, it just didn't make sense for them to be in there right now, so. I'm open to new banks at any point. We structured that so that we can onboard people whenever.
Mhm.
You know, I don't know that I'm in any hurry to go out and ask for more because we have enough interest right now. But, you know, if it starts to drop off, I may inquire with some other banks. I will mention it to Huntington. I have a conversation coming with them next week. Just because they're kind of the biggest player in our community, by far the biggest bank. For good, bad, or ugly, but that's what they are.
Ugly is a
So-
good.
You
Yeah,
like them or you don't.
speaking of super regional,
Correct.
so that's growing. So I think we're in pretty good shape there. We'll keep working on that. Our new staffer here is taking the lead on that, is doing a good job with managing the workflow on that. So we're happy with how that's going. Cash flow management and local investment opportunities, I only list because we have a new auditor, you have a new budget director. This is a moment for us to have those conversations. So Matt and I have talked a little bit about that. You know, I have not talked to the new budget person. Jackie, I was gonna say, not the other.
Jackie Peck.
Jackie Petty, yeah. So once he is more settled, we'll probably do some outreach on getting the meeting together on that. But that's, I think, something that we want to do. So that's that. Nothing more to report there.
Okay.
So. Anything else?
I will make a motion to adjourn.
Okay,
I will second.
moved and seconded, and without objection, we are adjourned at 2:44. Our next meeting then will be in June in your office upstairs. So,
That'd be great.
That'd be
You
great.
got a couple, I mean.
I'm excited to see it.
Mike
Yeah.
I think I thought of it, but you don't do anything, and that was Mike's. He said he took pictures of all the places he went, and so less than a